Welcome back to the deep dive. I want to start today by asking you to picture a script. It's a physical script, maybe a bit yellowed at the edges, that you've probably held in your hand since you were, 5 years old. It's the life script.
Oh, I know this one. Go to school.
Get good grades.
Don't cause trouble. Get a safe job with benefits. Save, 10% of your paycheck.
Avoid the fancy coffee.
Clip the coupons. And then you just wait.
That's the operative word, isn't it? Wait.
Yeah.
You wait for 40, maybe 50 years. You trust the stock market to do its thing.
And the promise is that when you're 65, you'll finally have enough of a nest egg to stop working. Yeah. To finally start living.
It's the standard operating procedure for the middle class. It feels safe. It's accepted.
That's what everyone else is doing.
Exactly.
Wow.
But here's the provocative question I want to throw at you today, and it's the whole reason we're here. What if that advice isn't just slow? What if it's actually a trap? What if the safe road is mathematically guaranteed to keep you mediocre?
That is a heavy premise. But it's exactly what we're unpacking today. We're doing a deep dive into a breakdown by the content creator Amu of a book that's honestly a bit of a cult classic in financial circles, The Millionaire Fastlane.
And I have to say, calling this material subversive is, putting it lightly. I read through our source material, and it basically takes that get-rich-slow method.
Which is what most of us are taught to do.
Right, and it just shreds it. It calls it a gamble with your life. So our mission today is to deconstruct the 3 roadmaps to wealth discussed in this source. We're going to look at the gritty math of why getting rich slowly usually means getting rich old.
It's all about looking at the underlying variables. But before we even get into the roadmaps, the sidewalk, slow lane, fast lane, I think we need to address the elephant in the room for the slow path.
Okay.
The source makes a huge point about how the slow lane relies on things you just cannot control.
Specifically, the market. You are literally betting your financial life on the economy behaving itself for 40 years.
Right. And if you're going to play that game, or even if you're trying to escape it, you need to know the temperature of the room. You need data, not just, hope.
Which brings us to a tool we really wanted to highlight today. The source talks about market bubbles and busts and how they can wipe out a slow laner. If you want to track where we actually stand, whether the market is overheating or cooling down, you need to check out the Buffett Indicator app.
It's a fantastic iOS app. It's on the Apple App Store, and it's designed to track the total market temperature based on Warren Buffett's favorite market valuation metric, market cap to GDP.
It's basically a logic check against all the hype out there.
It is. It helps you track the total market temperature, and it provides daily alerts on the Buffett indicators so you can actually monitor for market bubbles.
Exactly. So, action item right off the bat. Search for and download the Buffett Indicator app from the Apple App Store. It's a great way to keep your finger on the pulse so you aren't flying blind.
Absolutely. Okay, so with that market context, let's look at the roadmaps. Amu breaks down the source material into 3 distinct paths. And honestly, the first one is where a lot of people are, even if they don't realize it. The sidewalk.
A sidewalk. It sounds gritty, unpleasant.
It is. The sidewalk is essentially the poverty trap.
Okay.
But here's the nuance that gets missed, and I think this is where listeners need to really pay attention.
Okay.
The source defines the sidewalk not by how much you earn, but by your mindset and your math.
So wait, you're saying I can earn 6 figures and still be on the sidewalk?
100%.
Yeah.
You could earn 7 figures and be deep in the sidewalk. The formula is really distinct. Income equals debt plus expenses. Notice what's missing from that equation.
Savings, investments, any kind of future planning.
Exactly. There is no future variable. Money comes in, and it immediately goes out to pay for the past, which is your debt, and the present, which is all your expenses and consumption.
So it's a lifestyle of total liquidity constraints. You're living paycheck to paycheck, no matter how big that paycheck is.
Precisely. It's financial chaos. The sidewalker mentality is driven entirely by instant gratification. The source uses a really sticky example here that we see in the headlines all the time.
Let me guess. Professional athletes.
You got it. The broke millionaire phenomenon.
We always wonder how that happens.
This is exactly how. You see an athlete earning, say, $5 million a year. Somebody says, wow, they're rich. But if they spend $5 million a year on cars, mansions, and entourage, their net assets are 0.
Or even negative.
Usually negative because the spending often outpaces the cash flow thanks to credit. They're spending against future earnings that might never happen. An injury, a contract cancellation.
And boom, the income stops, but the debt is still there. That is the sidewalk. It's a tightrope with no safety net.
The sidewalker thinks wealth is their income, but wealth is actually what you keep.
Okay, that makes a ton of sense. But I'm guessing most people listening to this deep dive aren't on the sidewalk. They're responsible, they save, they have a 401k. They're doing what they were told.
Which puts them squarely in the next category. the slow lane. And this is the one that really gets uncomfortable because the slow lane feels like the right thing to do. It feels moral, responsible.
That's what our parents did, right? Go to work, save money, retire.
The source calls this the mediocrity trap. The script is sacrifice today for a tomorrow that is decades and decades away.
And the formula changes here.
It does. Now, wealth equals salary plus investment returns, specifically compound interest.
And we've all seen the charts. If you save $200 a month starting at age 25, assuming an 8% return, it sounds so great on paper. Why does the source call this a trap? It sounds like common sense.
It comes down to the math of uncontrollable limited variables. This is where the source really dismantles the conventional wisdom. But let's look at that wealth equation again. It relies so heavily on your salary.
Okay.
But your salary is tied to your time. You are selling your hours.
And time is the one resource you just cannot scale.
Correct. That is the hard ceiling. You have 24 hours in a day. You have roughly 40 working years. You can't just decide to work 400 hours a day to 10x your income. So your primary wealth engine, your salary, is capped by biology and physics. You can raise your hourly rate, sure, but you can never stop trading time for money.
That's a pretty depressing realization. You hit a ceiling just because you're human. But what about the other part, the investment part? Compound interest.
Sure, but compound interest needs a massive amount of time to work effectively on small sums of money. And that brings us to the second uncontrollable variable, market returns.
Right. Which brings us back to the Buffett indicator we mentioned. You don't control the market.
Not at all. You don't control the economy. You don't control your employer. The source had this terrifying stat about the danger of a market crash right before you retire. It's called sequence of returns risk.
Right. I mean, imagine you work for 40 years, you do everything right, you're 64 years old, ready to retire, and then 2008 happens again, or some massive correction, your portfolio just shrinks by 40%.
Exactly. And you did nothing wrong, but nearly half your life's work is just gone. Because you surrendered control to the market. You're just a passenger in a car driven by Wall Street.
So that's the Fastlane paradox. The so-called safe road is actually incredibly risky because you have zero control over the leverage.
And the ultimate cost is your life.
Yeah.
The key takeaway from the slow lane is that you are trading today's freedom, your prime years, your youth, your energy, for tomorrow's freedom. But that transaction only settles when you are, frankly, too old to enjoy it.
The source calls it wheelchair wealth.
Wheelchair wealth.
Yeah.
It stings, doesn't it?
It does. You're the richest person in the graveyard. Okay, so we've established the problem. The sidewalk is a disaster. The slow lane is a gamble where the price is your youth. What's the alternative? Take us to the fast lane.
So the fast lane. And we need to clear up a misconception right away. The source material is very, very adamant about this. The fast lane is not a get-rich-quick scheme.
It's not about luck or crypto coin.
Not at all. It's not about scamming people. It is a business strategy. It's a mathematical system that's just based on totally different variables.
Okay, let's look at the math then. We had income, debt plus expenses, then wealth, salary plus interest. What's the fast lane formula?
In the fast lane, wealth equals net profit plus asset value.
Okay, hold on. Net profit and asset value. That sounds like accounting class. Let's break that down for a second. Why is that so much better than a salary?
Let's start with net profit. So net profit equals unit profit multiplied by units sold.
Mm-hmm.
The magic here is in the units sold. Remember the slow lane. Your denominator was hours worked, and that is capped.
Yeah.
But units sold, that has no real upper limit.
Right. If I write a piece of software or invent a gadget or write a book, I can sell 1 copy or I can sell 10 million copies. It doesn't take me 10 million times longer to create it.
Exactly. That is the concept of decoupling. This is the crucial insight. You are detaching your income from your time. You build a system once, and it pays you again and again. That is real leverage.
I love that. In the slow lane, 1 + 1 = 2. In the fast lane, 1 + 1 could equal, 1,000 if the leverage is right. But what about that second part of the formula, asset value?
This is the part most people miss. And it's where the real wealth explosion happens. In the slow lane, your asset is just your savings account. In the fast lane, your business itself is the asset. And it has a multiplier.
A multiplier. Explain that to me like I'm 5.
Okay. Imagine you have a lemonade stand. It makes $100 a year. If you want to sell it, what would someone pay? Maybe $50. It's not worth much because it's just a job.
Right.
Now imagine you own a software company that makes $100,000 in profit a year. And it runs automatically. If you want to sell that business, investors don't just pay you for 1 year of profit, they pay for the future. They might pay a multiple, say, 6 times or 10 times the profit.
So if my business makes $100,000, I could sell it for $1 million.
Yes. And here is the math magic. If you increase your annual profit by just $1 and you have a 10x multiple, you've just increased your net worth by $10.
Whoa, that is a massive difference from a salary. If I get a raise at my job, I just get the raise. My asset value as an employee doesn't really go up. I can't sell me Inc. when I retire.
Exactly. In a job, you are the asset, but you can't sell yourself. In the Fastlane, you build an external asset, a company, a brand, a patent that appreciates based on performance, not just time. That's the exit strategy.
This sounds amazing, but I can hear the listener right now saying, okay, great, so I should just quit my job and start a business. I'll sell, I don't know, knitted socks on Etsy.
And that is exactly where people get tripped up. The source is very specific. Not all businesses are fast lanes. A lemonade stand is a business, but it's not a fast lane. To qualify, a business must pass the 5 commandments or the CENTS framework.
CENTS, sense. Okay, let's run through these, because this is the filter. If your business idea doesn't pass these, you might just be building yourself a job, not a legacy. What's C?
C is for control. You have to hold the reins.
Okay.
This goes back to that risk we talked about. If you're building your entire business on someone else's platform, say you rely 100% on YouTube ad revenue, or you're a driver for Uber.
Or you only sell on Amazon.
Exactly. You don't have control. You're sharecropping. You're farming on someone else's land. If YouTube changes the algorithm, you're done. You can lose all your revenue overnight.
Got it. Don't build a castle on sand.
Yeah.
Next is E for entry, the barrier to entry test.
The rule here is simple. As entry barriers fall, competition rises. If I can start your business by just filling out a form, then so can 10 million other people.
So things like network marketing, drop shipping, all those side hustles we see on social media?
Usually, yes. If anyone can do it, then anyone will. And when supply goes up, prices crash. You actually want a business that is hard to start. The difficulty is the moat that keeps the competition out.
That's so counterintuitive. We're wired to look for the easy way. But the source is saying, if it was easy, everyone would already be rich. Okay, N for need. The source called this the most important one.
This is the big reality check. We're always told, follow your passion. The force argues that is often terrible advice. You have to follow the need.
Do what you love and the money will follow.
The source says that's a lie. The market is selfish. It doesn't care about your love for underwater basket weaving. It cares about its own problems. People pay for solutions.
So stop looking in the mirror and start looking out the window. Find a problem and fix it. If your passion happens to solve a problem, great. But the problem always comes first.
Exactly. You don't hunt for money. You hunt for problems. Money is just the reflection of the value you provide. Okay, T for time.
This connects back to that decoupling we talked about.
Yes. The test is, can the business earn money while you are not there? If you have to be there personally to deliver the service, like a massage therapist or a consultant billing by the hour, it's still a job.
It might be a high-paying job. You might charge $500 an hour. But if you stop working, the money stops.
And you can't scale it. You can't clone yourself. Fastlane businesses are automated systems, software, content, product lines, things that exist independently of the owner. You have to be able to make money while you sleep.
Which leads us to the final one, S for scale.
Magnitude. Can you serve enough people? A coffee shop that serves the local neighborhood has a hard ceiling. It's physically limited.
But an online store that sells specialized coffee beans to the entire country or the world, that has scale.
Yes, it relates to what the source calls the law of affection. To make millions, you have to impact millions, or impact a few people with massive value. But generally, you need that scale.
So to really hit the fast lane, you need a business that you control, that's hard to enter, that fills a need, that works without your time, and that can scale to millions. That is a tall order.
It is. That's why the fast lane isn't easy. It's actually much harder work than the slow lane in the beginning. You're building a complex system.
But the payoff is that you compress 40 years of financial results into maybe 5 or 10.
It requires a fundamental shift in how you view the world. The source talked about moving from being a consumer to a producer.
That's the core psychological shift, isn't it?
It is. Most people walk through life as consumers. They see an ad, they buy. They see a problem, they complain. A producer sees a problem and thinks, how can I solve this? How can I build a system to fix this for everyone?
It's almost like seeing the matrix code. You stop looking at the product and start looking at the business model behind the product. You stop asking, what should I buy? And you start asking, what can I build?
Exactly. And you stop trading your limited time for money, and you start building systems that print money. And I think it's so important to remember this quote the host highlighted. Wealth is not an event, it is a process.
Right. We see the event, the tech founder selling their company for $50 million. We see the headline, we think, wow, they got lucky.
We don't see the process, the years of grinding, the late nights, the failures, the refining of the system that led to that one event. It's not a lottery ticket, it's a construction project, and you have to be willing to lay the bricks.
So let's wrap this up. We've gone from the sidewalk spending everything you make to the slewing, saving, and praying for 40 years, to the Fastlane building assets, leverage, and control.
The choice, ultimately, is about how much you value your time. Do you want to sell it to the highest bidder, or do you want to use your time to build something that eventually sets you free?
A powerful question to chew on. Now, before we let you go, we have to cover our bases.
Indeed. Please remember, all analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
And if this deep dive sparked something in you, if you want to listen to our full deep dive about this topic or access more advanced content, welcome to join Deep Value Club membership or subscribe to us on Apple, Spotify Podcasts channel, Deep Value Investing, and luluvc.com.
I want to leave you with one final thought, going back to that commandment of need. Look at what you're doing for work tomorrow morning. Ask yourself this: are you solving a problem for the masses, or are you just fulfilling a personal passion on a time clock? The answer to that question might just